Thank you, Sharas. Thank you, team. Sorry. Thank you, our business people and everybody all over the world. You know, I am a banker and I feel very intimidated because normally I speak on one-on-one basis with people. And I know you guys, when you call into our offices, normally we get intimidated and we'll bombard you with a lot of banking jargon. And today I'm actually in the spotlight. I feel like I'm in the spotlight being interviewed today. But nonetheless, I really appreciate this opportunity. All right, like Cyrus has said, my name is Efnasi. I come from Standard Bank, and I'm in business banking, and I have been in banking for quite some time. The only thing that I know best is banking. I never done anything in my life other than banking, and I've got a passion in banking. All my studies, formal studies, have been in banking, and today I'm really glad to be with you here. And thank you to Adrian for touching most of the important parts in terms of what we expecting from our clients in order for us to help them. I think to the entrepreneurs or business owners that are in this platform, I must actually start by welcoming you, and maybe start with stressing the importance of you guys. The contribution of small businesses to the development and well-being of any country has never been in doubt. You guys really are the people that are carrying any country, and myself, including everybody who's here today. We are very grateful to you. On a global scale, it is estimated that 80 to 90% of new jobs are created by small businesses. The South African small business contribution to the gross domestic product is estimated at 50%. You see how important you guys are. And that of the developed countries are at 90%. So guys, I think I really appreciate this symposium, as it does. As you can see, we have got a lot of capacity that we can grow our business and also solve our country and social ills together here with our within our township. Sorry, what is that? Wait again. Sorry, let me switch off my phone there. Within the township businesses here, guys. I really appreciate you guys. In the world's #1 economy, for example, the United States of America, the small business sector makes 99% of all businesses and employs 51% of the nation's private sector workforce. Small businesses in the United States of America contribute 47% of business sales and accounts for 51% of United States' gross domestic product. Can you imagine, guys, if we can support all the small business in South Africa, we can change the picture. In South Africa, small business contribute 40% of the gross domestic product and employs half of the private sector workforce. Guys, the team, we still have quite a lot of capacity here and opportunity that we can actually grow together. And this is where us as Standard Bank and any other banks come in to try and assist in growing your businesses. I think we must appreciate that our government has put in quite a lot of initiatives. And while the government's commitment to promoting small businesses is not in question, its track record in supporting South African small businesses is not well regarded. I think you guys you have had the experiences of dealing with our governmental institutions as well as banks. Many well-meaning but ill-founded interventions have failed to facilitate growth of small businesses. And most of the times when I'll take it back, maybe when I started, I mentioned that I've done my studies into the small businesses. And as well as within the banks, we have got quite different divisions that we do assess a lot of challenges that our clients do face. Critical failure to many businesses is lack of capital and its high costs. The banks we have come to realize that this is actually one of the inhibitors for businesses to grow. The key findings of the Global Enterprise Monitor report frequently cite the following as inhibitors to entrepreneurship, that is business people: access to finance, poor primary and secondary education. I think most of you, I think especially the first speaker, Simpiwe, mentioned that he knocked on several doors and he got a decline. He did not get his finance. And I guess most of you guys have had that experience, which is a not very good experience. The poor secondary school and secondary school education, it really affects our business people, in that most of our application for finance requires to complete lengthy and complicated forms. And obviously with lack of education, it becomes very difficult. This is where banks like Standard Bank and other big banks come in, where we have got relationship banking people that will be able to assist in that regard. A relationship person will be able to simplify that, take you through, and guide you accordingly. I'll now start sharing my screen here for you guys to see. I did not want to share it first because it was going to cause a bit of confusion. I think for today, because of time, I will speak about what banks can do for you guys in your businesses. As the banks we've got, businesses, in most of the time when people start with their businesses, you find that because of the complexities that we go through and challenges that we go through, a lot of business people start their businesses by maybe using personal savings, loans from family and friends, bank finance. And to Adrian's point there, sometimes you do equity finance, where you would sell shares for people to get a shareholding in your company and assist you in terms of your working capital, or to grow your business or whatever. What do we need? A lot of people, I think, to Simpiwe, I will keep on referring to him because he touched on quite a lot of important things that do affect a lot of businesses, business people. The banks offer quite a variety of loans. I can say amongst the banks, there's nothing that you will never find within the banks. For example, as Standard Bank, we have initiated a process whereby we custom make products to our clients. I'll give you an example. I guess you guys, a lot of you guys, when you want to start a business, or when you want to buy a truck for your business, or when you want to buy a home, in most cases, people don't really care what type of a loan that you want. However, when you go to a bank, you'll be told, we'll give you a vehicle and asset finance, we'll give you a data finance, we'll give you a medium-term loan. But you guys don't really care. All you want is finance to enable you to do what you want to do. Yes, I'm saying within the banks, we have got all the products that we can tailor make to suit your needs. However, they set the specific products that specifically fit in certain times. For example, we have got an overdraft facility. Overdraft facility that is used to bridge. It's a short-term working capital that you use to bridge between the time when you're expecting to pay your creditors and when your debtors are going to pay. So obviously, this one we cannot give you a long-term loan, as it will be a mismatch. A long-term loan, you find that in most cases you repay the loan over 5 years. So therefore, it won't be wise for someone for the bank or any financier to give an overdraft facility for a long-term loan. And then we've got what we call a business revolving credit. A business revolving credit, I think the one that is most familiar to people is a credit card. where the bank will give you a facility. Say, for example, give you for simplicity, I'll give you maybe 100,000. You would have a limit of 100,000 where you can use, and you've got a set repayment amount where you can use, and you'll be paying as long as there's available funds. You can revolve and use the fund without having to go back to the bank and apply for that. And then we would have a medium-term loan. Medium-term loans, these are loans with a specified time and a specified repayment amount. These are very ideal in that ideal for people that will be buying, maybe expanding businesses, or maybe buying properties, and they want the repayment to be done over a long time, and they've got a certain amount that they're comfortable in paying back. It helps in that the loan will be amortizing every month. And then we've got commercial property finance. That is, as name states, is for financing your building, your warehouse, or your offices, etc., etc. And we've got data finance. Data finance is a product that is specifically, it's more like a working capital. I think it's closely, I can say it's closely linked to an overdraft. However, this one we normally is given to companies that you find that maybe, as you may know, or when you go to apply for funding, in most cases you'll be asked for security, for overdraft, and a lot of people don't have security. But you may find that a company has got good data. You have invoiced good companies. So what the bank will do now will then take those data and then factor them in. We do what is called data factoring. The banks in most cases across the board, the norm is the bank will advance you. For example, if there's an invoice, will advance you 75% of that invoice. For example, you will invoice 100,000, and you give proof to your bank. The bank will release immediately 75,000. That is 75% of that, and they will keep 25%. That will be paid over to you once that data is paid in the amount in full. Then we have got contract finance. This one is actually it has proven to be very, very good for businesses that within the space of startups, where you'll find that a lot of institutions are giving small businesses a lot of jobs or work or on contract, and you find in most of cases you have got challenges in having finance to start up that project. That is maybe then the banks or finance houses will look at your contract, and based on the contract we will look at the cash flows and we'll say, okay, we will finance you a certain your needs within this contract. And that contract it gives the banks or the financer comfort that you'll be able to service whatever is advanced to you. What do the banks look when lending? The criteria for lending is not, guys. I must actually be very clear here. These are not cast in stone. Every situation differs. However, these are generic. So if you cover these that I'm going to present now, you stand a good chance of getting your loan approved with any financier. The most criteria, we look at owner's contribution. In most cases, the financing, the people that are our bank. Let me say, I will use for the sake of this presentation, I will use the bank. When banks lend money to you guys, we look at your contribution. For example, we would preferably like to do a one-to-one lending. That is, if you contribute R1, we also would like to match that R1 in terms if you are borrowing, and this is linked to your equity, and also we will for intuitive lending we would ask for your cash flows, and the cash flows must be realistic. For example, maybe you are a person who is selling fed cooks in the location. You know that your customers, they always per week you're making maybe 20,000 rands. Per month, you are making on average of 80,000 rands. And the cash flow should be along those lines to say your income is around 80,000 and your expenses of buying flour, electricity, etc., is around this. So the cash flows must be realistic. In most cases, you find people putting unrealistic cash flows. For example, using that example I gave, a person putting 500,000, and when you or you find that the company this year is doing 100,000, and when a person comes to apply for a loan, he's saying, I'll be doing 500,000. The question will be, how are you going to achieve that? So it becomes a bit unrealistic, and there will be questions asked there. So when doing your cash flows, make sure that it's realistic and within reason. That also the ability to carry debt or repay the loan, and it's also is linked to your cash flow projections. So there must be an evidence of ability to repay the loan. For example, that contract example I gave above, that contract can be, we will check whether that contract has got sufficient funds to be able to repay the loan. And again, guys, on contracts there, I must actually admit, I wish I had a lot of time to explain. Some more often than not, a lot of people get really upset when banks decline your finance. It's not that we don't want to lend, but in most cases, when a bank declines your finance, ask the banker, what is wrong? How can we make it work? We have found that as lenders, that in most cases, the contracts that our clients get, they are not in our client's favor. They are in the favor of the person who is giving the contract. And in most cases, the contract is not realistic. You might find, you find that there's a lot of clauses that are not your favor. That will make you for you to be able to carry out that contract a bit more difficult, and lead you to default, and lead you to get in trouble with the bank. You must remember, when the banks lend money, we are investing in your business, and it is our interest that we really want you to succeed and pay back the money, and you make profits from whatever we lend. Because the money that banks or any financier lends to you is the money that belongs to other depositors. So we cannot lend it recklessly. And besides, we are regulated by the banks, so that we don't do reckless lending for profiteering. We also look at the owner's profile. For example, we would use the bureaus to check whether you are a person who likes taking loans, and you don't pay back, or you default and disappear, or you are a person that your character is not really a trustworthy person. So those things, we look at that. We look at also at management skills and financial marketing, technical skills, etc., as well as qualification. Qualification, yes, if it's a big business, yes, we'll look at formal qualifications. But as you may know, sometimes this qualification in our space, we have got very little qualifications in terms, for example, if you take a person who is in the location, maybe making, selling those fed cooks or selling those stuff. So the qualification there becomes your experience within that industry. And in most cases, we will look at tangible collateral. This one, the bank will normally take as in case there's a default. You are unable to pay, and the banks will take comfort in the tangible collateral that you can provide. And sometimes intangible collateral, we do take it as well. For example, I'll go back to the issue of the contract. If we lend against the contract, we will say, okay, let's take cession of that contract. And also, when we do lend against debtors or debtor finance, the debtors become your security. And sometimes we would ask for personal assets of the owners. Hence, you'll find that in most cases, when your business, like Adrian alluded, that the business is a separate entity from the owner. Normally, when the bank lend money to you, you'll be asked to sign personal surety, and that personal surety, you are actually signing off your personal assets there as collateral. And then again, you find that the banks, we are by law, we need to be work within the environmental regulations. For example, we look at in the environment, the industry risk. For example, I must admit now, with COVID, you saw that a lot of restaurants were closed for a long time, and a lot of our customers in restaurant industry suffered. So lending there becomes a bit tricky, because we know the challenges that the industry found itself in, and the location of a business. For example, if you go to the if you go to orange farm, for example, and you start selling things that are ideal for a market, that a certain market, obviously, if no matter how good that product is, you are selling to the wrong market there. And also we look at competition. How are you differentiating yourself amongst the competitors that are around there? And also you look at entry barriers to entry. For example, this one is actually a lot of people don't normally value this, but this is a very, very valuable thing that banks look at. For example, today you may be a successful vendor selling your wares in a certain corner, but the barrier entries are very, 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 very limited. It's easy for anyone to copy that and go in. You may have started at the sole trader there, and people see, you are making money, and people with more funds, they come in and invest in that and start businesses next to you, and you find yourself without customers and failing to repay your loans. So we look at those things, and we will always try to discuss with the customer and see how we can mitigate those challenges. The information that is required, financial statements of businesses, normally it will be, it's either, preferably the banks require audited financial statements, but as you know, because due to the law that protects small enterprises, up to turnover of less than of 30 million, it doesn't really need to be audited. However, it must be prepared by a competent person. We will require personal statements of assets and liabilities. This is what, when we try to gauge whether the owner, when they sign personal sureties, is going to be worth the paper that is written on. Projected income and expenditure, that is the cash flows, and cash flows for forecast. Amount and source of owner's contribution to the business, details of proposed collateral, legal company documentation, 6 months bank statements, or if you do not bank with Standard Bank. I think the last one is very important, guys. If you don't bank with it is important that you, as business people, you must have a bank account. It does not matter really whether you come to Standard Bank, though I would prefer that you really come to Standard Bank, but you must always have a bank account. It does help you when you want to lend. We have got quite a lot of products that we lend where we don't even need your financial statements or even security, where the banks will lend you funds based on the behavior of your account. For example, you would find that within Standard Bank, we've got a loan that we call BizFlex. This BizFlex is a loan that we give to businesses based on the company's turnover, and we can see that where we can see that the company is on average is doing this turnover, and they can be able to repay a loan. That one is easy. You can apply for it within a few minutes. You can get your money. So it is important, guys, that we do have bank accounts. Okay, this is where where we're coming to reasons, most of the common reasons where loans get declined. And I think you guys, you need to look at this carefully so that you don't get frustrated by the banks. Business risk is too high, business is not sustainable. For example, I will give a good example will be a restaurant. If you're going to do a new restaurant now to buy, and you want to buy a new restaurant, I think at this point in time, new restaurants are a bit risky in terms of how the banks view the cash flows from there, and lack of owner's commitment or contribution. If you come to someone to borrow, one thing that will be asked is, what have you contributed? And if you have not contributed anything, it can be by way of skills or by way of your money that you have spent in there. Any lender becomes very, 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 because your commitment is a bit not strong, because you can walk away from that bank from that business anytime should something start going south. Business plan does not provide adequate information. In most cases, when lenders assess your application, we need a business plan that is very detailed. And this we have come to realize that is a bit of an inhibitor, because a lot of people, you will go to people that are printing generic business plans. So hence, Standard Bank, we have come to realize that when we are encouraging our customers to go into our businesses and sit across the business banker and explain. Because when you explain to the business banker exactly what you want to do, we can actually come up with a business plan that is specifically suited to what you want to do. The purpose of the character or suitability of the owner. It speaks to the character of the key driver of the business. For example, there's some businesses that any investor will not want to get involved in. For example, human trafficking people, we don't want to fund those businesses. Or past credit history of the business owner. If you are a person that is a serial defaulter, you will find difficulties in getting your loans approved. Passive investment, owners not involved in day-to-day running. If the business, a small business, and they've got passive investors and the owner is not really involved in day-to-day running of the business, it becomes very difficult for any financier to lend, because now the success of that business is in doubt. Because of time, guys, thank you.